Good morning, good afternoon, good evening, and welcome to the Wednesday, the 22nd of February, Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. We're going to go through usual regular run through in here today, what we've had, what we've got coming up on the calendar, macroeconomic, geopolitical, fundamental events that are impacting markets right here, right now. And we'll take a look at how that relates to the charts. Now, yesterday, it was all about better data, seeing yields surge and equities sell off. And sometimes this is a little difficult to kind of fully understand, right? Why are we getting strong data and stocks lower? Okay, so some of you will know why and think it's quite normal. Others of you may be wondering exactly why. Why do we have strong data? So, where was the strong data? Well, let's step back a step first of all. Yesterday's data, we focused on this in yesterday's webinar, right? Look at this PMI data, the Purchasing Managers Indicator. It's a great lead indicator of fairly short-term changes in growth. GDP data is very, very lagging, right? We're looking back to a quarter ago. Okay, this PMI data is telling you where growth data is going to be in the next few weeks and months, right? So it's very much looked at. I worked at Credit Suisse for a number of years, and I had a very esteemed colleague, Jonathan Wilmer. Okay, and Jonathan is a super strategist, brain the size of a planet, super intelligent guy. And back, I think decades ago, he built a set of indicators. He realized that there was a strong correlation between the PMI data. And they back tested this and showed strong correlation between PMI data. They put a load of other stuff into it, and they built an indicator called risk appetite indicator at Credit Suisse, and it was much sought after by the hedge fund and investing community because this risk appetite indicator was based on PMI, and PMI was shown to be a really good indicator. Why is it a good indicator? Because these are the people. Remember, PMI stands for Purchasing Managers Index. These are the people at the very forefront of corporations, okay, making decisions in real time about whether they're going to increase their inventory, run their inventory down. Are they going to buy in extra stock? Are they targeting sales? All these kind of things the purchasing managers is involved in, right? And it's about their views on how they're, it's basically, it's data, okay, it's how their company's doing, but there is, to an extent, it's a survey, right? It's kind of it's how they're feeling it. Are things looking better or worse than they were a week ago, a month ago? So it's very reactive because it's kind of it's at the very sharp end of corporations. It's what's happening right here, right now. But it's also a survey, and that survey can change very quickly, right? Because it's how people are feeling about, is the company doing better than it was last month, right? It's very now, right? So it's very reactive. So it's a very good lead indicator of future economic prospects. And most of his data yesterday from Europe, if you see, most of it's in green. Okay, all this PMI data: France, Germany, Eurozone, UK. The little blips we had were in manufacturing. They were a little disappointing, but mostly the services were all better, and the composite data, the mix of the two, was better. And if we scroll down to the US, that was better too. You can see in here, PMI, green, 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 all better than expected, all showing a strong rebound despite the slowdowns we've seen because of the increases globally in interest rates. We're seeing strong rebounds in the global economy, in the European economy, which, remember, the European economy has had significant spikes in inflation. The UK, very significant spikes in inflation, and there were real concern that and this all really on the back of COVID, on the back of supply chain, but then exacerbated by the fact that we've had a war in Europe, on our doorstep. And the concerns around that, sending inflation spiking higher, and real concerns, around energy prices, and it was going to take us into recessions. Okay. The data's all pointing, we're avoiding recessions. The economies are rebounding relatively strongly. Okay. And so this yesterday, even though markets have kind of been reacting slightly, this yesterday led to a surge in yields, and equity markets finally reacted to that and went lower because of the anticipation of the mantra that we've been having from global central banks. We've been having from the Fed: higher for longer. Okay. It's been headlines, that's what they've been saying. The markets have kind of been ignoring it. I want to look at in here the So this is the yield chart, the US 10-year yield. And you can see last week we spiked above this peak from the very end of last year. It's the last trading day of the year. Okay, that peak was a 390 and change. Okay, we spiked above that last week, but then yesterday broke it and stayed above it. Okay, into the highest level since over here, since November, the beginning of November of last year. That big sell-off there, that was a CPI day. Okay, so it's the highest. So it's not a sell-off; it's a rally in bonds. It's a move lower in yields. Okay, but that was some CPI data. But nevertheless, the yields moved yesterday to their highest position since November. Okay, to nearly the highest position. We're aiming back at the highest position of the whole move. Okay, that's back to the high yield moves. Okay, that we saw last year. Sorry, I've jumped right the way off in here. Let me try and get us back to today if I can. Okay, so we had this big spike in yields, but look, yields have been going to lower prices. And remember, this is the upside down version of not that chart. Let me go and get the bond chart in here. So we go and look at the futures chart in here. Here's the 10-year notes. So it's been selling off in here since the very beginning of February. Okay, so bonds have been selling off. Lower prices, remember, equals higher yields. We've already taken out the equivalent low in here from the end of last year. We took that out last week on the futures market, but the yield only broke through. And really, the people are watching the yield. Okay, so the yield only broke through in here yesterday. Okay, significantly through yesterday to the highest yield point since November. But we've been moving to higher yields. And what's happened to stocks in that phase? Okay, as we've been moving to higher yields, stocks have struggled. Okay, they haven't gone down, but they've struggled to go up. So they haven't gone up. So we've been going to these higher yield moves, and since then, since the beginning of February, look, we've struggled to make new highs. It hasn't gone down. It's been choppy and sideways, but the market's kind of held in. But then yesterday was kind of the surge that we saw to these new high yields. Yeah. And the important thing in here, this is not just a US phenomenon, right? Okay, we've seen, but it's global data. Okay, this data, jumping back to the data, it's global data, this PMI data, and it's taken us to increase concerns of global central banks. And it's not just US Treasury bonds moving to high yields, it's global bonds. And I'm going to show you that shortly. It's not only the Treasury bonds, but also let's go and look at the Fed tool in here. We're now starting to price in a percentage, a growingly strong percentage that at the next, this was basically nailed on for a 25 basis point hike at the next meeting. Okay. Like it was like 90% or something. Now, look, we've got growing risk that we're going to get a 50 basis point. And now we're even like a week or two ago, it was uncertainty whether we would go up to 75 from where we are now, up to the 525 to 550. 2 weeks ago, the favorite, pre the employment data, pre the CPI data, we were looking at the peaking rates being at 500 to 525. Only a week ago, it was kind of even Stevens between 500, 525 or 525, 550. Now 525, 25, 550 is nailed on. And if anything, the growing risk, as much as it being the lesser amount, only 50 basis points up from here, is that we get a whole point up from here by July. If we go out to September, okay, it's saying 500, 525 here, but there's a growing risk. This column is rising, right? The 550 to 575. Let's go and look at that on a historical. Okay, the 550 to 575 in here. If I go and take all of these out, 550. The trouble is here, it's so annoying. Oh no, I need to leave that one on. Okay, I need to sort this out. I can just click them all off. But look, there was zero risk for September, 550 to 575, pretty much, all the way through. So apart from November last year, okay, zero risk. Now up to, where are we? Something like 20% risk, right? 25% risk or whatever it is, okay, by September. Look at July as well. Why does it not just keep them on? It doesn't, though. I'll just do it. I can't go through them all and do this, guys, but, we'll go through just a couple of these two. But even by July, right, look, growing risk in here, over 40% chance in July, right, is we're at 525 to 50. So growing risk now, increasingly growing risk of a higher rate in here. And if I actually go to the 550 to 575, here's the 550 to 575, very little risk of 575 to 600, okay, but there is a little risk now of even a rates going up to 575, 600, okay, by July, okay, so a small risk of that as well, and certainly a much higher risk of us being at 550 to 575. We're up at like 25 plus%. Okay, so higher has been priced in, longer hasn't been priced in really. If we go to the current, we're still looking, look, 500 to 525 with an expected peak of 520. We're still looking for a cut by the end of the year, right? I just don't see it coming. I think the market has started to listen to higher. It's not listening to longer. Okay. And what I want to reiterate here as well, this is not just. So we had Wall Street posting its worst day of 2023, worst day since December it was in here. And why? And this is good for right, not if or when, but how fast. It's how fast we're going up, right? We're how fast we're rebounding. Look, economists from the United States to Germany to Britain are showing an unexpected pickup in business activity. That's the PMI data. But markets are again giving a thumbs down to these indicators, just as inflation once again became the biggest pain point for investors after they conveniently put away such worries last month. Strong growth cements the case for higher interest rates. This is the fear, right? Fed funds rates are now pricing for the Fed's budget overnight interest rate to reach 5.3% in July and 5.18, still pricing in a cut by the end of the year. And look, for the Bank of England, 95% chance now that the next we're going to get a rate hike next month. Up only on Tuesday, it was at 90%. So we're nailing on that certainty, right? And all this is negative. And it's not just, right? I just want to reiterate, it's not just the US. Here, growing risk of a more hawkish Bank of England. Here, look, Deutsche Bank, okay, putting out their forecast for the ECB, the terminal rate, that's the peak in rates for the ECB. They're now flagging up 50 more than they were previously, okay? They were looking for the cycle high to be 325, Deutsche Bank from the ECB, now 375, another 50 basis points. They're expecting hikes of 50, 50, and 25 in March, May, and June of this year. 50, 50, 25, another 125 up. Look here, JGBs, Japanese key yield. Remember, the Bank of Japan defends the 10-year yield. Okay, they're in buying bonds to keep yields low. Okay, their threshold is 0.5%. We breached that today. We went to 0.505%, and Bank of Japan announced an unscheduled bond buying operation to stop yields going up. So we're seeing, a more hawkish tone being anticipated, expected, and priced in the UK, in Europe, the ECB, in Japan, the Bank of Japan. Okay. And clearly from the Fed as well, and clearly from the yield move that we saw yesterday, the highest yields. This is what's, even though we've been moving higher in yield significantly, look, from 335 through 390, okay, we've been moving, okay, over the last 3 weeks throughout February, the last couple of weeks, 2-3 weeks, okay, it's been this acceleration higher to the multi-month high yield that's then really peaked the market interest, the equity markets. They've listened to this strong data. They've listened to the yield move, having kind of ignored it, right? So as I say, that we were ignoring it through early February, trying to, clinging on to the positive news, clinging on to the growth story, and ignoring the fact that the Fed might go higher. And then we broke down. We just dipped below this low actually last week, but plunged through that low. It creates here on the S&P 500 and the NASDAQ. You've got, like, whether you want to call it a quadruple top, a double top, a triple top, whatever it is, it's a top, and we went down close to that last week and plunged through it, creating this topping pattern, and all the risk now is lower. Okay. Now, that all being said, clearly we've got another fly in the ointment, because we go into the data, and what do we have? Well, not much data today, but we get the Fed, right? So critical now, and obviously there's focus on the Fed. If we go to look at, I don't know, I just closed that 5 things to start your day. Let me just reopen that 1 second, guys. Recently, okay. So 5 things today. That's all about the Fed, right? Waiting the Fed minutes, okay. And the important thing is here, we've had a few Fed speakers, okay. Notably, okay, we've had Loretta Mester and Bullard, who are relatively hawkish, two of the more hawkish policymakers. They've been, advocating a 50 basis point hike at the last meeting, right? Was it only them that advocated that? Remember, these two are non-voters. They do not vote at the moment, okay, this year. They're non-voters for this year. Mester and Bullard are non-voters, but they are definitely among the more hawkish members, okay? And they've been advocating we should have had a bigger rate hike at the last meeting at 50. What we're going to get for the minutes. Are we going to get confirmation that rates are probably going to be going a lot higher than previously expected? Are we actually now moving towards even though the market's moving towards pricing in, if we go to March, okay, we're still only pricing in, we're still 81% that we're going to get only a 25. Is the risk, should it be this be a lot higher, that we're going to get a 50 at the next meeting? Are the minutes going to tell us that the Fed, the higher for longer mantra, is the market going to listen to the longer? Right? Because the market is, as we said, pricing in a rate cut at the end of the year. The Fed are basically telling us rates are going higher than you think. And not only they're going higher, they're going to go up there and they're going to stay there. Right? And the market's pricing, because the market in here thinks the Fed's going to cut because we're going to dip into recession. Well, you know what? This data here from, this is today's, but yesterday's data from the PMI, global PMI, is telling you quite the opposite. Markets are rebounding. The labor market is strong. We know that, right? The rebound in consumption remains strong. Retail sales remains relatively strong. All of this data remains relatively strong. It doesn't look like we're going to go into recession in any of the major global economies, right? So all of this points to a move still higher in yields, okay, a potentially realization of this more hawkish tone, this longer. I think the longer bit is what's not being listened to, and we have to really watch out for that, because that can significantly hit equities. Now, going out further is potentially a buy opportunity, but right here, right now, I think, even though we're getting a little bounce in here on the Nasdaq, we're getting a little bit of a bounce in here on the stocks, on the S&P 500. If we go and look at the 15-minute chart, what does it look like? It looks like a little bit of a dead cat bounce, right? It's been flat all overnight. We're getting a little bounce. I think if we do get a rebound, we're looking to sell into that rebound. So I would be wary of buying into this today. I'd be looking to sell into it, but clearly later on, it's going to be all about the Fed, okay? And if the Fed gives us any sniff of a more hawkish tone, I think we could see a significant sell-off again in here today on stocks, okay? So just watching out for that, guys, okay, is what I would have to say going into today. I'm not going to go into loads of levels and details. We've already looked at this topping pattern, whether you want to call this a quadruple top, 1, 2, 3, 4, 5. You could argue it's a 6-point top. Look, 1, 2, 3, 4, 5, 6-point top in here. Repeated failures, boom, 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 boom. That's on the S&P. Nasdaq in here, same thing. Sorry, that's the daily. Let's go to the intraday. Okay, up here, right? Look, 1, 2, 3, 4, 5, 6 peaks, okay? 6 failure peaks as well for the Nasdaq, okay? That's a significant barrier now, all of that. And that the multiple failures up at that area in here for both the S&P and Nasdaq, and the breakthrough, the interim low down here, says to me, now you could get the pullback. Remember that the pullback move would be to the breakout point. So that's the low there. The low on the Nasdaq, we could see a move back towards there. So move back towards 12,240 on the Nasdaq, and on the S&P, the low, where's the breakdown point there? Is around 40, or I can tell you the actual number, 40, 60, 75, okay? You could see a bounce up towards there, right? I'd be selling the hell out of it if it gets back up to there, right? Particularly if it gets there today ahead of the Fed. I don't think it's going to get that high. If these start to roll, I mean, for me, the strategy would be wait for these to roll on the short-term charts, on the 5, 10, 15-minute charts. If they start to roll, if they start to break support, going short, it looks like we could have another significant down day. Have I got anything more? I'll have a quick look at, I don't think there was much more in 5 things to start your day in here. So Fed minutes key, Chinese audit move, not going to affect us. Chat GPT crackdown from JP Morgan, who cares? Global stocks extend the sell-off. We know that. We've looked at that. And then what we've got in today. But it's all going to be about the Fed going into today. Anything else of interest? Morning bid. Hang on a minute. I look at the day ahead. Only 7 weeks in the many of the favoured investors look spent right yet. So worst day of the year so far. Fed minutes of debate over rate hike at endgame. This is what it's all going to be, right? Are they look at where do they see terminal rates? Are they going to step back to more aggressive on their hiking process? And is there any chance of a rate cut this year? I'd say no. And the market's continuing to price that in. Okay, so if we look in here this morning, we are seeing little bounces, but only after big down days. 2% on the S&P, over 2 on the Dow, 2.5%, best part of 2.5% on the Nasdaq. And if we go and look at the European bourses playing catch up on the downside today, we're down between 0.3, 0.6, and 0.9 between the German, the French, and the UK stock indices this morning, playing catch up, because obviously we had it was more of a later day sell off in here. So these exchanges were closed, but they're continuing to push lower into today. And this is all about the data being strong. Yeah, the strong data leading to anticipation of more hawkish, not just the Fed, global central banks. Obviously, we get the next set of data now from the Fed, or the next indication, but it's all concerns about central banks going higher for longer, and we've got to watch out for that today from the Fed minutes. All right, guys, I'm going to wrap it up there. I'm going to wish you any questions from anyone. No questions. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you with another bull versus bear webinar on Thursday. Bye.